Hello and welcome to today's Premium Account Market Update for March 2017. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 with a particular focus on FY 17 and FY 18 earnings. We look at the technical trends and we tie that in with our portfolio allocation and short-term market outlook. If you'd like to know more about the service, please contact me using the details on screen, leon@investorsignals.com. Moving straight into a graph of the US market, up on screen there is the Dow Jones, and we essentially spent 2 years consolidating between the 15,000 and 18,000 range, and in or about September of 2016 we've had a breakout roughly in the order of 10% in the Dow Jones. That puts the US market on a forward PE of about 18 times earnings and an expectation of about 6% earnings growth, or another way of looking at that is the average earnings per share for the S&P 500 needs to deliver about $133 of earnings per share. Roughly when the market was trading within this range here, it was delivering around $122, $120 of earnings per share. So we've had roughly in total a 10% increase in earnings per share, but obviously we've had a large expansion in the average PE ratio for the US equity market. And that in part was driven by the low bond yield. So now what we're starting to see is the early stages of US interest rates beginning to rise, and on this Wednesday we find out whether the Federal Reserve raise rates, which is pretty much a certainty, by 25 basis points, 0.25%. But what will be interesting is any commentary around what the forward expectations of the market become insofar as do we sort of get indication there'll be 3 or 4 rate rises over the next 12 months, and that will have some impact as to the market's perceived fair valuation for equities. I'm probably of the view that equities are close to full value, if not slightly overvalued, and therefore you're just better off positioning on the basis that equity market moves sideways and have a fairly defensive sort of characteristic to your portfolio given where valuations sit at the moment. Let's have a quick look at a couple of other of the major indexes. So let's have a quick look at the Nasdaq, and then we'll move on to the XJO. So similar thing here with the Nasdaq, where it consolidated all the way through till late 2016, and then we've roughly had a 10% breakout to the upside here as well. On our local market, a little more volatility here. We had a combination of both banks and resources underperforming throughout this period, which meant our market really sort of made a fairly significant low around February, and then again in June, and it wasn't until sort of June that the bank stock started to perform better that we've had this sort of rally through to here. And at the moment we're consolidating between 56 and 5800 at an index level. Up on screen there is AGL. So this stock appears expensive by any measure. It's trading 22 times earnings on a 3.5% dividend yield. The market's expecting dividends or earnings to increase by about 20% over the next 12 months. If that does happen, it still puts the stock on into FY 18 on 3.9% dividend yield and about 19 times earnings. So I have some concern that AGL's getting expensive, and at some point over the course of this year we'll see a sell-off, and we'll get an algorithm signal that'll flag sort of the buy on the dip opportunity, and that's when we're happy to sort of step back in and take a look at AGL. Amcor, we're comfortable with this name at the moment. It's at 18 times earnings on a 4% dividend yield, but I think there's a prospect of the company growing earnings better than sort of the 4-5% that it did in its recent results, and on that basis the stock continues to trade sideways around $14 to $15. So we own it here. We're selling the covered calls and getting that extra income. AMP certainly on our radar. On a 5.5% dividend yield, 14 times earnings. I think we'll just watch this at the moment, but around this level we may see the stock build a support level. I think sort of AMP, if you look at it as a funds management company, starts to look a little more attractive. I think sort of some of the traditional advisor type financial planning advisor type network business probably has its challenges, but when you consider the earnings opportunities for AMP as a pure asset management company, look, I think it's worth just keeping it an open mind to AMP over the next year or two as a potential contender as a comeback stock. ANZ, so we don't mind this, although we do sort of see the risks building for all the Aussie banks. We had a buy signal down here at around 28.50. I think it's pretty close to resistance and likely to run into some selling pressure now. APA not doing anything there at present. ASX, we like this company, and I think it's obviously very defensive, but it's expensive. It's 22 times earnings, 3.9% dividend yield. Even if it grows earnings at 3 to 5% over the next 12 months, it's still on a 4% yield. But fully franked dividend. If we saw market weakness, so some sort of volatility pickup, and we saw ASX drop down to around $47, we'd certainly be a buyer of it on a dip back there. AZJ, we don't mind this. We just see it as expensive, 19 times earnings on less than a 5% dividend yield. But what worries us here is the company pays out 100% of its earnings in dividends, and we think therefore it's subject to potentially a dividend downgrade over the next 12 months. BHP, we had been quite cautious on the resources if you go back since the beginning of this year, both in the January recording and the February recording. We were sort of looking at either taking profit on the resources or where we'd own them from lower levels, we'd sold fairly tight covered calls. I think we're only now just starting to see some value emerge again. And it's hard to say sort of ultimately, do they trade another 10% lower? But I suspect we're getting into a range now where these resources might be worth keeping on the radar as a potential buying opportunity. I do think given the overvaluation in the broader market, you need to be having a think about where stop losses would exist or how you go about adding the exposure into the resources. But the algorithm engine's flagging a buy signal at the moment in both BHP and Rio. BHP from a valuation standpoint trading about a 4.5% dividend yield and about 12-13 times earnings. But Brambles, so we've seen this company pull back substantially as a result of them effectively highlighting that the earnings are not going to grow at 8% like the market had expected, and maybe more like 3% is where the earnings growth rate is. So on that assumption, it puts the stock about 18 times earnings on a 3.5% dividend yield. I think Brambles is actually okay value down here on a relative basis to other names in the market. We own it, and we're selling tight covered calls at the $10 level to drive the extra income out of Brambles. CBA, 3% underlying earnings growth. Probably the only risk here is really, is there something at a macro level globally that sort of causes the offshore hedge funds again to sort of look at the Australian market as a shorting opportunity and risks around property. That was it's not that CBA made any less money during this period here than it was doing up here. This was really a combination of offshore hedge funds shorting the Australian banks and a lot of negative headlines around Australian property prices or property market in general. And I just think that that's always the risk to the banks, is you see a pickup in that type of concern, and it can have a fairly substantial or outsized impact on the valuation of the business. But right at the moment, CBA is on a 5% dividend yield, trading 15 times earnings, and I think the trigger would just be to say, look, if we see it back below $81, you probably want to be a little bit cautious. What we're doing here is selling fairly tight at the money covered calls. We've used European options, so we're keeping access to the dividends, but really forming a view that the banks are either full value or likely to move sideways where they are at the moment. Coca-Cola, we like this name. We own it in portfolios at lower levels. We've kept exposure to it. We've sold the covered calls at predominantly around $10.50. We've collected around 30 to 50 cents, depending on at what point we sold them in premium for that. We've collected the recent dividend. The stock's at 18 times earnings on a 4.5% dividend yield, but keep in mind underlying earnings growth's only around sort of 4-5%. Computer share, I think keep this on the radar. I think you're going to see a point where it collapses under its own weight. From a valuation standpoint, it's 20 times earnings on a 2.5% dividend yield, and I don't believe that the companies, whilst higher interest rates obviously help the Computershare business, I think ultimately if we see it trading $15 on some further exuberance, it might be a level where we see the stock really sort of fall away from that type of price point. CSL, so we like this name. It is getting expensive though, back on sort of 32 times earnings on a 1.5% dividend yield, but the market, and rightfully so, has been very encouraged by the upgrade that the company delivered from 10% earnings growth to 20% earnings growth. So we own this in most portfolios, and we'll continue to sort of buy it on a dip, but we'll probably wait and look for the next algorithm signal that where the stock pulls back and we see a further sort of buy on the dip signal there to identify some value in CSL. Caltex, we like this, although we recognise that the technical structure is not supportive. It's making lower lows, lower highs, but at these levels the stock's on a 4% dividend yield, trading 13 times earnings, and we see it as reasonably defensive. So volatility picks up in global equities. We think Caltex probably is unlikely to be buffeted in the same way that some of the banks and resources will be. So for that reason, we're keeping exposure there to Caltex. Goodman Group, look, obviously this has been one of the darlings of the property sector. The stock's 17 times earnings on a 3.5% dividend yield, but just as US interest rates on the bonds the yield on the bonds start to move a little bit higher, we've seen some selling come into these property plays just over the last few days. But in most cases, they still have a fairly excuse me, bullish structure in place. GPT, 16 times earnings on a 5.5% dividend yield, growing underlying earnings at around 5%. I think owning this name and selling tight covered calls over it is a good income line for portfolios. Insurance Australia Group, we like this name. We do hold it in a number of portfolios, but we've started capping the gains now. Don't see it doing too much above where it is at the moment. 16, 17 times earnings on a 4.6% dividend yield. The insurance margins came down a little as we expected, from 14% down to around 12. The company has announced a share buyback. We know the company's been disciplined on the cost control side of things, so I think it stays elevated up near this price point, and again any sort of pullback in the market, we'd see it as a buying opportunity to add Insurance Australia Group back into portfolios. IPL, so we've been long this name, we've taken profit on it, and we're now really waiting for a more substantial pullback before we do anything there in IPL. James Hardie, we own this name. As I've indicated in the last two recordings, we'd be happy to deliver this stock over the next 2 weeks at the end of the March expiry, and we'll probably just sit on the sideline for a little while whilst we're aware that obviously the growth in the US housing construction has been a bright spot for the US economy, with James Hardie trading 28 times earnings and only on a 2.5% dividend yield. I think the risks are increasing if we get into a interest rate cycle, or the market just having the perspective that the Fed may raise rates quicker than they expect, then I think maybe James Hardie could be susceptible. So for that reason, if we can, we've done well out of it, we've owned it from lower levels, we've collected a lot of call option income, and if we can be delivering it and just sort of sitting on the sideline, I think that might be the preferred approach there. Lendlease, so they delivered a good earnings result. You may be just starting to see the very early stages of some minor settlement defaults coming through in some of these property names. We saw it to a small extent in I think Villawell. We saw it to some evidence of it in Mirvac's result. We've seen maybe some early signs in Lendlease, but nothing to the point where it's impacting profitability at this stage. So we're just keeping an eye on that as a reason to be a little bit cautious. But right now, if we look at the technical structure, it's bullish, and we'll have another look at this if we see a pullback in the weeks ahead. Mirvac, not doing there at the present. Medibank Private, so this is a name that we continue to like and we hold it in portfolios. We think owning this name and selling at the money or fairly tight covered calls, we're driving 10-12% cash flow from the dividend and the call option, and we see the stock as fairly defensive. Keep in mind that there was no revenue growth and there was no profit growth in the latest earnings result. Macquarie, we're not doing here at the moment. National, recognise that this is breaking out, making higher highs and higher lows. but still our view on the banking stocks is they're getting close to sort of hitting resistance at these levels and maybe at best track sideways, so we'll continue to sort of watch that in the weeks ahead. Newcrest, we've got lower lows, lower highs here. Gold's a little bit out of favour at the moment, but if we obviously see volatility pick up, you could see Newcrest actually put in a support level, so it's worth, and we've certainly got this on the watch list, where we're sort of keeping an eye on it around this $20 level to see if the stock actually finds support at or near that point. Origin Energy, we don't mind this on the pullback. We think that around 625, 650 the stock looks okay value. In most cases we've sold covered calls at $7 there to drive extra income out of Origin. So we're thinking that it kind of bumps along at or near these levels for the next sort of 3 or 4 months, but maybe in the back half of the year we see Origin trading at higher levels. Orica, not doing there at the moment. Oil Search, we see this consolidating. Obviously the last week of trading in oil prices hasn't helped Oil Search, with oil being off roughly 5%. Actually I should say closer to 10%. Oil Search has struggled a little bit in that environment, but we do own it in a number of portfolios and we've been aggressive with the covered calls over Oil Search. Qantas, so making higher highs and higher lows here at the moment, and you have to sort of continue to give that the benefit of the doubt until we see price break back down through any of those recent support levels. QBE, beneficiary of higher US interest rates. The stock trades on about 15 times earnings on a 4.5% dividend yield, and we see sort of fair value at around this $12, $13 level, and if we see sort of that outlook for higher interest rates this week, then it may be supportive for the QBE share price. Ramsay, keep this one on your watch list. I think, whether we see it back down at maybe 62, 63, but ultimately I think this sell-off will prove to be a buying opportunity while the market is a little bit out of favour with Ramsay. So it's come back a long way. It was trading 32 times earnings, now it's 25 times earnings. It's on about a 2.25% dividend yield, but I think just keep an eye on it as it goes through this current sell-off, because we don't see it too often in the case of Ramsay. Rio, this looks like a little heavier than BHP, but again we've got the algo buy signal here. Whether Rio gets down to sort of $55, again hard to tell, but I think sort of keep these on the radar as a potential sort of oversold play in the market. My suspicion would be any rally would be relatively short-lived, and I think you need to see these more as a trading. So I think you sort of see this as an oversold move, and you may get a short-term bounce from that oversold move, but I'd be cautious of probably. So quite often what you see is a selling, an oversold sort of price action and a rebound that captures roughly half of sort of this downtrend, and then that can often give you an opportunity to sort of take the profit. So we'll keep an eye on that as a trade, between now and the next recording. To get Rio, I have it on about 10 times earnings on a 5% dividend yield. Both BHP and Rio delivered great earnings results. South 32, not doing anything there at the moment. Centre Group, we don't mind this, again, being sort of aware that coming into sort of the last part of this week, some of these yield sensitive names have been sold off a little. But right at the moment, this stock's on about 17 times earnings on a 5% dividend yield. And where we do own these names, again, we've been very aggressive with selling covered calls, so we're delivering sort of 10, 12% cash flow out of them. Seek delivered an okay earnings result. I think the market still needs to see further confirmation that the underlying business can maybe be growing at 10% per annum. So right at the moment, we see it just continuing to track sideways at these levels. It's on a PE of 26 times earnings and not quite a 3% dividend yield. But I think when you look out over the next 6 months, putting aside that I think the next 2 or 3 months, it's probably not likely to trade too much higher than where it is. But if we start to see a bullish structure build in Seek, then it may be a name that we continue to sort of have exposure to over the next 1 to 2 years. Stockland, so the stock's on 14 times earnings, 5.5% dividend yield. The company reaffirmed that they're likely to grow earnings at about 7-8%. When you put that in the context Their earnings per share is 31 cents and the dividend of 26 cents. If we go back, say, 3 years ago, one of the concerns with Stocklands was they were paying out 100% of their dividends, 100% of their earnings in dividends, which were roughly around 24, 25 cents at the time. So we've seen the earnings pick up from around 24 cents a share up to 31, and the dividends stayed a little more stable. And that gives me some comfort that the company's actually building up a little bit more of a buffer there. But there's still sort of these risks around the property area. And for that reason, you're seeing the stock sort of trade on a fairly high dividend yield up at around 5.5%. At 475, we're looking for the stock to sort of break through that. Whilst it sits under that, I think the consolidation range is, say, 425 up to 475. Sonic Healthcare, so this is a name we like, so we hold it in portfolios. Again, we've been aggressive with the covered calls. Trades about 19 times earnings on a 3.5% dividend yield. Company's growing earnings at around 5%. It's one of those names, again, that we get the sense that even if volatility picked up in the global markets, Sonic Healthcare may be a safe harbour. So we've tried to sort of build more of those names in our portfolios than chasing risk at this point in time. Not doing anything in Santos. Suncorp, worth commenting on. We have owned it at lower levels. We've taken profit and sold out of it at around $14. The stock trades on about 5.5% dividend yield, 14 times earnings, and I think for the moment you'd have to say it's probably more bouncing sideways than any great evidence that it's going to fall in value. But for the moment we're sort of preferring to look elsewhere. Sydney Airport, so this appears to be sort of bouncing off an oversold level, 5.5% dividend yield. I think you'd have to be a little bit cautious here. If we saw the stock break below $5, say 85, then it may have another leg lower. So I think it's just a matter of sort of being a bit cautious and running stop losses in some of these cases on these yield names. And that what would cause Sydney to move lower would be the rally in US bond yields. And same with Transurban. If interest rates in the US move higher quickly, then some of these yield sensitive names are going to struggle. That's not our base case. We actually don't see that the US economy is actually strong enough for real, even though they may signal that it is. If we get 3 months out, I'm just not sure that the economic data actually will ultimately end up supporting 3 rate rises. But in the case of Transurban, the stock, we own this and we've been aggressive with the covered calls on it. So you can see here on the chart at around $11 we find support, selling calls at around $11.25 and turning that stock into a 10-12% cash flow. Telstra, interesting, the stock's now on almost a 7% dividend yield, 14 times earnings. Throw in the franking credit, you're almost up to 10% return on Telstra on a cash flow basis, but the technical structure is still terrible, and the last signal there was an algo short at around 5.25. Treasury Wine, so we've had a whole series of bullish signals here on Treasury Wines from back at $5, and again the higher low structure continues to stay in place with the most recent support at around $12. Not doing there in vicinity. Westpac, so again starting to break out. So after being in a downtrend and having a series of lower highs, we're now starting to see that turn into a bit more of a bullish structure, but a bit concerned on the banks from a valuation standpoint as to whether there's the capacity for them to move too much higher. Wesfarmers, this was a little bit out of favour a month back, and we saw it back down on the support level around $40, and over the last few years whenever it's traded down to $39, $40, it's found support and it tends to run into resistance up here around $44, $45. So I think it makes sense to look at selling calls up here. This rally in part is from the market getting excited about the prospect of Wesfarmers divesting their coal assets and possibly returning capital to shareholders in the next 12 months. I've got Wesfarmers on 17 times earnings on just under a 5% dividend yield. And in the case of Westfield, so we like this name within the property space, recognise that it's expensive on a 4% dividend yield, a little over 4% yield. But again, we've been selling covered calls at $9 and turning that into a 10 to 12% annualized cash flow story. Woolworths, so if you consider the last dividend was 32 cents here, let's assume that the next 12 months is far more bullish than that, and we actually get 45 cents per half dividend, so 90 cents for the year on Woolworths. What does that mean? That puts a stock on a 3% dividend yield. So I think we like this name. Clearly the structure looks positive, and we probably want to keep exposure to Woolworths but continue to run a fairly tight covered call over it because we're already pricing in a big uptick in earnings per share and dividends, and on a 3% dividend yield, you'd have to say it probably doesn't compress too much more. But I think it's possible that Woolworths could trade back up to say 27.50. So we definitely want to try to keep exposure to this name. Woodside Petroleum. So with that oil prices pulling back during the week, we're seeing Woodside come back down and test sort of the $30 level. Appears to be holding that. I've got the stock 17 times earnings on a 4.5% dividend yield. And there we are, back to the index. So the message really is that our preference is to seek out names that we think are going to have low volatility in an environment that global risk starts to pick up again. And it's hard to know what will ultimately be the trigger for that. But when you consider the Dow Jones, and let's bring this chart up as we conclude the presentation, when you consider that the US market's trading 19 times earnings or 18, 19 times earnings with a limited, when you still look at the US GDP growth, at best it's maybe 1.9% when you look at sort of where it was at the end of the December quarter. It'll be interesting to see at the beginning of April when we get the S&P 500 companies report their March quarter earnings, how the US multinational companies have fared, and in particular the US financials. But a lot of good news is priced into the US equity market, and therefore we're more of the view that you position portfolios on the assumption that it moves sideways or possibly even a little bit lower rather than sort of chasing the rally. But as we've highlighted as we move through the recording, there are buying opportunities, and some of the other more defensive names complementing it with a covered call and delivering 10-12% cash flow really starts to make sense to keep exposure to the equity markets on that basis. Thank you for listening in, and if you would like to discuss with me your portfolio or just in general how Investor Signals operates, please contact me on the phone number on screen or drop me an email, leon@investorsignals.com. Thank you.